February 28, 2026. While most people were going about their day, a coordinated military operation changed the trajectory of global markets. U.S. and Israeli forces carried out airstrikes on Iranian military and nuclear targets across several cities. Within hours, Iran responded with missile launches aimed at Israel and American bases across the Gulf region. Airspace closed, casualties reported, governments on high alert. Now the clock is ticking. In less than 3 days, financial markets in New York, London, Tokyo, and Hong Kong will open, and traders will have to answer one brutal question. What is the price of risk in a world where a fifth of global oil supply could vanish overnight? Headlines are already floating a staggering figure, trillions in potential market losses. Some economists have warned that in a worst-case scenario, global wealth destruction could reach tens of trillions of dollars. That sounds apocalyptic, but let's slow down and examine how conflict translates into financial damage, step by step, without hype and without politics. First, perspective. The total value of all publicly traded companies worldwide is roughly $124 trillion. A $5 trillion decline represents about 4% of that. Painful? Yes. Historic? Not really. Markets have dropped that much in days before. The real danger lies elsewhere. The key variable isn't the bombs, it's oil. Between Iran and Oman sits a narrow maritime corridor just over 20 miles wide at its tightest point, the Strait of Hormuz. Roughly 20 million barrels of oil pass through that waterway every single day. That's about 20% of global consumption. If that flow is interrupted, even partially, the math changes fast. There are alternative pipelines. Saudi Arabia can reroute some supply. The UAE has limited bypass capacity, but together they only offset a fraction of what normally moves through the strait. If shipping were disrupted significantly, millions of barrels per day would effectively disappear from the market. So what happens next? Oil prices react immediately. Even fear alone can push prices higher. A moderate escalation could send crude into the $90 to $100 range quickly. That's manageable. But if supply is genuinely constrained, prices could surge much further. In past energy shocks, like the 1970s oil embargo, relatively small supply reductions triggered massive price spikes. Remove 10 to 15% of global supply today, and crude could climb into extreme territory, $150, possibly higher. Sustained disruption would reshape the entire global economy. And that's where the financial chain reaction begins. When oil doubles, gasoline follows. That means households pay significantly more at the pump. But fuel costs don't stop there. Trucking, shipping, airlines, manufacturing, plastics, fertilizer, nearly every physical product relies on energy somewhere in its production or transportation. Higher energy costs ripple outward, pushing up grocery bills, airline tickets, consumer goods, and utility expenses. Inflation re-accelerates. Then central banks face a nightmare scenario, rising prices along with slowing growth. Cut rates to support the economy and risk fueling inflation. Keep rates high and deepen the slowdown. That combination, stagnant growth plus rising prices, is known as stagflation. It defined the 1970s. It's notoriously difficult to manage.
If oil remained elevated for months, major importing economies could slide into recession. Corporate earnings would weaken, unemployment would rise, consumer spending would contract. That's how missiles launched thousands of miles away eventually show up as red numbers in retirement accounts. But history matters here. Middle Eastern conflicts have flared before. During previous wars, oil spiked, markets dipped, and then stabilized once supply proved resilient. Investors tend to overreact to uncertainty and then recalibrate once reality sets in. So what makes this moment different? 3 factors. First, stated objectives. When conflict shifts from limited strikes to broader ambitions, the incentive to escalate increases. Second, scale of military positioning. Larger deployments suggest longer campaigns. Third, capability. Iran possesses asymmetric tools, regional proxies, missile systems, and strategic geographic leverage that allow it to impose economic costs beyond direct battlefield engagement. That combination elevates risk. Now, let's talk about Monday. Here's what traders are likely watching. Oil futures will open first. A sharp gap higher signals immediate fear. A move above $100 suggests markets anticipate prolonged disruption. Energy companies may rally because higher prices boost their revenue. Defense contractors could see gains amid expectations of increased military spending. Meanwhile, sectors sensitive to consumer spending and travel could decline sharply. Safe haven assets, gold, government bonds, certain currencies typically attract inflows during geopolitical stress. And then there's volatility. The VIX, often called the market's fear gauge, reflects expected turbulence in U.S. equities. A moderate rise indicates caution. A surge into extreme territory signals panic. But remember, markets price uncertainty, not headlines. If investors believe the conflict will remain contained, declines may be short-lived. If escalation seems likely, selling pressure accelerates. Let's frame this in three possible paths. Scenario 1. Contained conflict. Strikes and retaliation remain limited. Shipping continues. Oil spikes temporarily but retreats. Markets fall 5 to 10% and stabilize. Recovery begins within weeks. Scenario 2. Prolonged tension. Months of intermittent attacks, partial supply disruptions. Oil sustains elevated levels. Global growth weakens. Equity markets decline 20 to 30%. Recession risk rises materially. Scenario 3. Severe escalation. Shipping lanes close. Oil surges dramatically. Financial conditions tighten rapidly. Markets enter deep correction territory. Economic contraction spreads globally. Which path unfolds depends less on today's events and more on what happens next. Shipping activity through the strait, official military escalations, energy price trajectories, volatility spikes. These indicators will tell the story faster than headlines. Here's the core truth. Markets can handle bad news. They struggle with unpredictability. If investors gain clarity, even negative clarity, pricing adjusts and stabilizes. But when outcomes range from temporary spike to systemic shock, capital retreats. Could markets lose trillions? Yes, that's mathematically plausible. Is a catastrophic collapse guaranteed? No. Most geopolitical crises fall somewhere between panic and disaster. Over the next 72 hours, the world will get its first signals. Stay informed, avoid emotional decisions, understand the mechanics before reacting, because in moments like this, discipline matters more than drama.